Insights. I'm Eric. I'm going to talk about the flow of funds report, specifically the debt that the U.S. carries and creates on a quarterly basis, the enormity of it, the size of it, the way it applies to gold, silver, real estate, things like that, Bitcoin. People are investing in those for a reason, and let's give it some context. When people talk about the debt, maybe they talk about the federal deficit, but they're really underestimating the amount of debt that the system has in it. So I open up the flow of funds section. I talk about this. This is not inside the matrix, but this does get talked about and updated with subscribers. It's kind of an introduction to this so that people can get introduced into the blog and into the concepts that go about how this relates to some of the assets that we follow inside the matrix, particularly gold, silver, and Bitcoin. This chart focuses on the total credit market debt to the gross domestic product. Total credit market debt is everything inside the U.S. system. It's actually recorded inside the flow of funds report. It doesn't include things that are off the balance sheet, so to speak, and outside the U.S. But we can see that this tracks all the way back to 1921 and currently into 2020. But during the height of the Depression, the total credit market debt relative to the GDP soared to 326%. And as the world defaulted on a lot of its debt and we worked through it into the 50s, which ultimately got us out of the Depression, it fell to 128%. But since then, and since debt is no longer a concern for anyone, and largely the U.S. government generates it without any concern of paying it off or any intention of paying it off, the total credit market to GDP ratio has risen substantially. During the financial crisis, it rose to 381%. This was the Great Recession. This was the Great Recession that was supposedly supposed to cleanse all the debt and restart the world. But clearly we didn't drop very far. We fell from a level that was higher than the heights of the Great Depression to a low that remained above even the Great Depression lows or highs. So it really didn't change the trend, and it didn't do much. And then with the latest COVID-19 crisis and the amount of debt that we're creating from that, we've now spiked above the highs that we've seen during the Great Recession and financial crisis. We reached 415%. We've fallen back from that, but we're still well above the depressionary levels. This is what's putting so much pressure on anything this was putting pressure on confidence. This is what's putting pressure and driving up assets like gold and Bitcoin, because the world essentially understands that this debt will never be repaid. There is no intention of that. I do think that people still believe that somehow debt can be paid down and repaid, but it's beyond our capabilities at this point in terms of income. We couldn't collect enough taxes. We have to issue debt in order to pay and service existing debt. And this is why this trend continues to go higher. In each crisis, it stair steps higher to a point of which then the U.S. and the world will no longer accept U.S. dollar denominated debt, and we will default. The question is how. It won't be a direct default. They'll probably hide it. There'll be massive devaluation, but again, it could be cancellation of the currency. We should go to digital dollars, those types of things. And it's not going to solve the problem. It'll just hide the problem. This chart shows the scope of the debt created within the realms within the U.S. economy and the world. The top line is total credit market debt. The middle line is domestic financial, non-financial debt, which includes things like households. And you can see how much leverage households in the U.S. have achieved. The red line, or the green line, is the rest of the world, and it's much lower. The world, a lot of people believe the world is leveraged up in debt, but in reality, the U.S. and U.S. household is the leader. These lines that are way down here, financial debt, savings and loan, and federal debt. And again, they are much lower than the total credit market debt of the system and even the non-financial, which is household and the domestic sector. And it is the population which accepts the, we like to complain about the debt burden, we like to complain about our debt obligations, but we are essentially the ones that are driving this. So ultimately, that's what I've talked about over time is its reaction to gold, and it's the reaction here talks about reactions of gold. This is when they went off the gold standard. This is when we fell off the gold, closed the gold conversion window. Everything's free floating now. It's not like we're going back to the gold standard. It's just that there's not much left to do other than the price of gold will adjust. We've come up with Bitcoin and concepts in order to escape as a relief valve within the system. But the pressure for these to go up will continue as long as this trend is maintained. And honestly, I don't see anything stopping it until it breaks. And the question is why do we create so much debt? Well, we need to do that in order to generate economic output. This particular chart represents how much economic output per dollar of debt that we issue. In the height of the Depression in the 30s, when everything was collapsing, we used to get 32 cents of growth for GDP relative to the total market credit debt that we've created. When the Depression unwound and into the 50s, this number increased to the point where we were getting a little bit more bang for our buck in terms of the debt issuance. But since about the 50s, I wouldn't say it's the height of the American empire, but slowly it's been deteriorating down to the financial crisis where we get about 26 cents of economic growth per dollar of debt we issue. So the suggestion that we are returning to normal is an illusion, since we already are well below the Depression levels and we are continuing to trend lower. Essentially, the guess is how many more years will this be able to continue before the system grinds to a halt? 1, 2, maybe a few more 4-year cycles. I would say within 10 years it would be the most. And the law of diminishing returns states that we can issue an infinite amount of debt, but it will not create any marginal growth at some point. And that's why the end game is getting closer and closer. It's one of the reasons why gold is rallying. It's one of the reasons why silver will do so. Bitcoin's on a tear, but they're not separate. They're not separate ideas. They're both relief valves from a system that sees the growing risks that are involved with a system that's dependent on ever increasing amounts of debt. So this is the flow of funds report that we update and talk about periodically. This is quarterly data. We won't get an update. GDP gets updated a little quicker than the flow of funds report, but it is interesting trends. I will keep this up for people to review. I will keep it up on the YouTube channel that I have. There's more videos there for you to watch. They bring in the idea of trading individual assets within the matrix and through the process of the trade discipline of the evolution of trade. But this is more of an economic topic. It's more of a macro trend, but it is something to keep an eye on. It's maybe will help you frame the idea that there is no return from this. We are not going to get this under control. We won't be making America great again. Default is inevitable. It's just the question is how is default going to be positioned to the public, and will they accept it as this? When society's default standards of living take a large drop, sudden drop, it usually causes a lot of social disorder and civil unrest, and I'm pretty sure that this is what's on. We're headed towards this. You can blame it on the sitting president or anyone, but whoever sits there is going to get blamed for this. It's just a matter of time before a new face gets attacked for the same old problem, which they have no solutions for other than letting the invisible hand come in and cleanse the system. The crash that provides sows the seeds for the next cycle, provides the nutrients for the next growth cycle, but they refuse to do that. They try and create an endless debt cycle that is going to go on in perpetuity, but that is not how it works. That's not realistic. Eventually the empire crashes and burns, and we are heading towards that. But this is the flow of funds. This is the debt side. This is U.S. The problem's worse on a global scale. I don't have that data to talk about as specifically as I do the US data, but the concepts are the same. So that's where we stand with that. And watch more videos, subscribe to my channel, and thanks for watching.